Welcome to The Explainer. Today, we are digging into Lowe's latest quarterly results. And let me tell you, the home improvement giant just dropped some numbers that tell a really fascinating story about strategy, efficiency, and a huge bet on the future. So let's get right to the headline number.
Okay, right out of the gate, this is the number that's got everyone talking. $4.33. That's Lowe's adjusted earnings per share for the quarter. In a market that's been pretty shaky, putting up a number like this, well, it's a huge statement. It tells us Lowe's isn't just getting by. They're actually finding a way to thrive. So how in the world did they pull this off, especially in such a tough environment? Well, it definitely wasn't just luck. Lowe's delivered this performance because of a very deliberate, very focused strategy to own the entire home experience. Let's break down exactly how they're doing it.
The top line number alone is pretty impressive, right? Total sales hit $24 billion. That's up 1.7%. But the real story, the one that matters most, is on the bottom line. Their adjusted earnings per share jumped 5.6%. What that means is Lowe's isn't just selling more stuff, they're getting more profitable on every sale. That right there is the sign of a really well-run machine. To really understand the why behind those great numbers, you have to look at this one central idea, a strategy that Lowe's calls Total Home. And believe me, this isn't just some catchy marketing slogan. It is the absolute core of their game plan. It's driving every single decision they make. So this Total Home strategy, it really stands on 4 key pillars. First, a serious, relentless focus on the professional contractor, the pro customer. Second, they're doubling down on their online game, which, by the way, grew 7.5% this quarter. Third, they're expanding services. So they're not just selling you a water heater, they're going to be the ones to install it too. And finally, it's all about building a loyalty ecosystem that's designed to keep you coming back again and again. And to really supercharge that first pillar, growing the pro business, Lowe's just made a massive move. A huge move. They spent $1.3 billion to buy a company called Artisan Design Group. Now, this wasn't just another small purchase. It was a bold, strategic bet designed to grab a huge piece of the high-value professional market. Of course, a bet that big doesn't come for free, right? It has a short-term cost. The acquisition actually dinged their earnings per share by about 6 cents. But Lowe's is playing the long game here. They were more than willing to take that small, immediate hit in exchange for getting access to a massive new customer base and a much, much bigger slice of the professional home building pie. It's a classic move. Invest now for a way bigger payoff down the road. Okay, this all sounds fantastic for the company's future, but let's talk about what it means for investors. With all this strategic spending and growth, is the stock actually a good deal right now? Let's dig into the valuation. To answer that question, we need to understand a key metric called the P/E ratio. And don't worry, it's way simpler than it sounds. The easiest way to think about it is like a price tag. It just tells you how much you're paying for every single dollar of the company's profit. And just like with a price tag, a lower P/E ratio can often mean you're getting a better bargain. And when you put these valuations side by side, whoa, a really clear gap just pops right out. Lowe's P/E ratio is sitting at around 21. Meanwhile, its biggest rival, Home Depot, and the sector average are both up around 26. This basically suggests that compared to its competition, Wall Street is slapping a pretty significant discount on Lowe's stock. And it really seems like the experts agree there's plenty of room to grow. This number right here, $268.82, that's the average price target that Wall Street analysts have put on Lowe's stock. It's a clear signal that they believe the market hasn't quite caught on to the company's full potential just yet. And that confidence is pretty much universal. Get this, out of all the analysts covering the stock, 10 of them rated as a buy, and a grand total of 0, none, rated as a sell. That kind of unanimous thumbs up is actually pretty rare, and it just adds another layer of confidence to the whole story. But hey, valuation is only part of the puzzle, right? There's another critical area where Lowe's is quietly winning, and it's all about operational efficiency. They aren't just getting bigger, they're running a leaner, meaner, and more profitable business. Okay, this is where the story gets even more interesting. So look at gross margin. That's basically the profit they make on the stuff they sell. Lowe's has a little edge. But the really impressive number is the operating margin. That measures the profitability of the entire business. At 14.5%, Lowe's is a full point and a half more efficient than Home Depot. It means for every single dollar in sales, Lowe's is simply a more profitable company. So let's put it all together. What do you do when you're growing, you're more profitable than your biggest competitor, and your stock looks undervalued? Well,
If you're Lowe's, you bet on yourself. Big time.
Just look at this breakdown of where their cash is going. Yeah, they're still paying out solid dividends and they're making those huge strategic acquisitions we talked about, but look at that massive slice for share buybacks. They spent nearly $2 billion in just 6 months buying back their own stock. That is the ultimate vote of confidence from a management team that believes their own company is the absolute best investment they can make. So we're left with this one big question. Lowe's is running a more profitable operation. It's making these bold acquisitions to capture new markets, and it's pouring billions of dollars back into its own stock. The strategy is clear, and the execution looks strong. The only question left is, will this be the masterstroke that finally allows Lowe's to close that gap and truly go toe-to-toe with its biggest rival? Well, only time will tell.